Hey everyone, welcome back to the Daily Gold Podcast. Today we have returning guest Greg Weldon of Weldon Financial. Greg is an author, former trader himself, a commodity trading advisor, and he produces research for the retail and institutional crowd. Greg, as we get started here, obviously a huge day in the markets, not just news-wise, but looking at gold and silver, they certainly shot right up after the Fed announcement. Before we get to the details of that, big picture question I have, because the precious metals markets have been moving to the upside for about a month or so, how much of this is already priced into the markets, and what do you think has to happen for precious metals to be able to continue this move, not just for a month or two, but let's say over the next year?
It's a great question, Jordan. First of all, always have to look at things from the perspective that it's not necessarily, what does the news mean? It also is, how much of that news has been discounted by the market, because it does tend to be a discounting mechanism. And to the degree to which it is discounted today's announcement by the Fed, clearly it had not fully discounted it because gold is up, $38. I think that when you start to break it down and look at actually what they've given us, there probably is more upside in the metals here. I think that this was more than even some of the more dovish speculators out there had hoped for. It wasn't a 1.2 trillion package, but it could be because it's open-ended. And really, what happened today was the markets just got an extra $40 billion a month to run with, $10 billion a week, $2 billion a day. This is the Fed's just going to print another $2 billion a day and throw it at the markets, and that's where it'll end up because the real economy doesn't need it. Lending, in the commercial and industrial sector has been up a little bit, not in the residential sector, not in the consumer sector. Certainly, the labor market remains chronically broken. We could get into the details of that at length if you wanted to, but I mean, it is so far from being fixed, let alone fixable. That the bottom line is this liquidity that the Fed will now provide will make its way directly into the markets. We're seeing that today. Some of it's been discounted, probably need to see more of it discounted. And that actually sets up with our technical targets for this breakout, which were the previous, not record highs, but secondary highs at 1804 in gold and the 3750 level in silver. So those are still very much in play, and it'll be interesting to see what happens, when, not if, we continue to climb to those levels.
Okay, let's move over and talk about Europe, because there's been a lot of news coming out of Europe, and I mean, they haven't actually done anything yet, but a lot of this news and job boning has effectively pushed some rates down and, I guess tempered the crisis for the time being. I mean, what exactly is Europe going to do? And, well, another question I should ask, I mean, what do you think Europe might do? And if they do anything, is that going to add more fire to this gold rebound?
Well, when you talk about market discounting versus, the reality of the news, this is a good case in point because, wow, can ECB President Draghi get any more bang for his buck from his rhetoric? I don't think he possibly could have orchestrated the decline in bond yields in Europe any better than he did. In fact, the second largest 13-week decline in Spanish 5-year bond yields in history, second only, of course, to the first attack that was unleashed with the LTRO, the original LTRO. So, I mean, they didn't have to spend $1.2 trillion or 900 billion euro to get almost the same impact in bond markets, which then makes it a little more problematic as opposed to the U.S. side in the sense that they need to now deliver at least a good portion of that. This is highly open to debate. I mean, we could really argue both sides of the coin here. We could suggest that Europe has gotten the wake-up call it needs, and Germany's softening has been a positive thing in the sense that it will make it a smoother transition to something more significant from a banking side, from a central banking side, and from a fiscal union side. So we could say that the slow boat evolution is in a positive direction. The problem with that is it's a near-term and a long-term problem. It's all well and good that they facilitated this big decline in bond yields, which allows Spain and Italy and France to roll over their debt at costs that are not disadvantageous to them. but it's rolling over debt, okay? It still doesn't eliminate the sovereign debt issue. It still doesn't do anything in the sense that there's a imbalance trade-wise in Europe, and it doesn't do anything in the sense that Europe is in its own economic funk that is not going to be easily addressed by conventional monetary policy, because even in Europe, conventional monetary policy is largely exhausted. So, it sets up a very interesting dynamic in Europe in terms of, okay, buy the rumor, sell the fact. I mean, is this the thing where they, when they finally start buying bonds, and let alone, all the little nuances we could discuss. First, that Germany's capped their involvement. Second, that you have to basically plead poverty to get involved. And then third, once you do that, you're open to even more austerity. At a time when austerity is the worst thing you could probably want economically. And let's not forget, as GDP declines, that makes the debt to GDP ratio even bigger. So that's a problem unto itself, that you are having difficulties in generating growth, and you need growth to as one of the two prongs to get out of this problem. So, man, there's a lot of question marks that remain in Europe.
Okay, now let's transition to the dollar, and maybe a technical question here. The dollar has essentially, as you know, been in a big range for the last 4 years or so. I mean, we had that big rally in 2008 to early 2009 from about 72 to 89. Then we had the initial Greek crisis in early 2010. Dollar goes up to 89 again, but it's a slightly lower high. Over the past 12 months or so, it seems like the euro crisis has been a much bigger deal than it was previously, yet the rally in the dollar only from about 73 to 84. So for our listeners out there, what I'm getting at here is the rally in the dollar essentially peaked out at a much lower level. So I guess my question for you, Greg, is can we interpret that as a long-term negative for the dollar, that it's so weak in the long term that even though we have this building problem in Europe, that the dollar itself peaks out at 84, which was much less than the 89 it peaked out several years ago?
You can most definitely make that case. The technicals do present themselves in that fashion. So, yes, to answer that specific question, I think in terms of the dollar and its lack of a bigger rally, I mean, it also is a very harsh reminder that the dollar problem, remains, and that, the U.S. is more of a debt offender than Europe is. So the reality is that we have more debt to sell by the end of the year than Europe does. We have, as of last count, which was, I believe, Tuesday, it changes on a daily basis. It includes Treasury bills, so it isn't always as large as it might seem, but the fact of the matter is, you're selling more Treasury bills than ever every month now. The fact of the matter is, you have $1.7 trillion in debt to sell in the next 3.5 months. The point of the matter is, that is the largest 3.5 month debt maturity dynamic in our history. Okay, so it's all well and good that the Fed has brought this $40 billion in MBS. For me, the real key in terms of even the dollar is the bond market. The U.S. bond market, because it's going to be difficult to see how you're going to place all this debt, and then you have another, 1.7 next year. So really, it is the near-term dynamic is 15 months. You also have, the new debt that we're generating with our new annual deficits. Public borrowings, $280 billion above last year. That really cuts into the impact of quantitative easing. It's a direct offset. So, this also is a negative in terms of what is going to happen to bond yields in the U.S. in the next 3 months. I think what could be happening here is that you're shifting a little bit of focus towards that dynamic. And at the same time, you're coming under the understanding that the U.S. economy is in trouble, okay, that the labor market is chronically broken, that you can't even generate enough jobs to meet population growth, that millions of people fall into the ranks of not even counted anymore on a monthly basis. I wonder if the dollar's not reflecting some of that too, that maybe, hey, it's all well and good to produce quantitative easing, but we have a bond market problem still looming, and we have a macroeconomic problem that we don't really see a solution to. That's negative for the dollar, and it'll be interesting to see if you start to hear more about those things as the reason why the dollar's going down, as opposed to it's because this is a positive outcome for Europe. No, I don't see it that way. And I think that the real telltale point to that is look at dollar against the Chinese renminbi. Okay, it rallied, something we haven't seen in years, okay, over any kind of sustained basis. Renminbi was depreciating. That has reversed. The dollar has broken down against the Chinese currency in the last couple of days, and I think that that to me is a very telltale sign that, you know, this is a dollar dynamic more than a euro currency strength dynamic.
Since you mentioned China, I want to touch on that. There's been some rumors that they're going to come out with a huge stimulus package. I mean, last time we talked, you said they were way behind the curve because real rates over there were rising. Can you give us an update on China and what you see happening there?
Yeah, they actually have announced a couple of stimulus packages. One that's directed at building approximately, I forget it was kilometers or miles, I think it was 1,200 kilometers of new roadways. They have a new big package to support the railway system, which has been, you know, direct investment in the railways has been in the decline the last 18 months, so they're trying to boost that. They're also providing new tax rebates to exporters. As you see exports really starting to take a hit. It's not that they're down nominally, but the growth has completely disappeared. And when you look at where that growth has most disappeared is clearly in Europe. So that's one thing. And their import demand down big. Numbers came out just this week. We wrote about this, in fact, yesterday, a 12-page report specifically detailing the dynamic going on in China. Imports down year over year, imports down across the board in terms of commodities, and imports down across the board in terms of trading partners. And you start to look at places like Brazil and Russia and some of the dynamics going on there. It's very interesting. The bottom line is they have introduced some fiscal traction here. So that seems to be a positive. The other area that they're focusing on is credit creation. They're announcing, you know, supports for banks to be making loans specifically to exporters, but to also to other small businesses. And the August credit bank lending and money supply numbers, very interesting. The largest August increase in their bank loans ever, and by you know, almost a 50% margin over the previous largest August increase. August, not a month where you normally see huge increases in credit in China, and you did. So, you know, they have fallen behind the curve in monetary policy. Real rates are still rising, not as much because inflation just upticked, and that actually has been part of the strength behind the renminbi. But they are, you know, moving to address some of the issues. The stock market reacted, the currency has reacted, even the bond market in China has reacted. 5-year bond yield up significantly in the last 2 weeks. So it'll be interesting to see, you know, if that continues. And let's not forget we have a political situation not only in the U.S. but in China, where, you know, Communist Party leadership is scheduled to be turned over. It's done once every 10 years. You know, it's scheduled for sometime in the first quarter of next year, and already there's some controversy brewing behind the scenes in terms of the succession ladder within the Communist Party itself. So, a lot to be watching in terms of what's happening in China.
And also in terms of what's happening in China, what's going on with their gold demand? I mean, I know that there is some, I guess you could, if you were a bear, you could make the case that China's slowing down way too much and that's going to affect their gold demand. So can you update us on what China is doing as far as their gold buying?
I would say that gold demand is still up. It's just not as strong as it was. And I think you can apply that to many areas within the Chinese economy. I mean, jewelry sales are still running around, 14%, year over year. It's been pretty constant. It's actually upticked in the last 2 months. So, I mean, it's still, demand is still there. I think when you look at the World Gold Council data also in terms of, supply and demand, you see some interesting leakage in demand. We see it in India for sure. So it's not the one-way street that it was, a couple of years ago. But that could also change pretty quickly. I think particularly if China were to go into a slowdown, this fiscal push that they've begun to generate does actually come with some increase in their debt to GDP ratio, which has never before really been a problem. But the end of last year was at 43.5%. We know 60 is kind of a tipping point. My guess is, based on the numbers we have at hand, that that's going to push above 60. And you're going to start to ask their net, sovereign debt is not, again, huge, but, relative to GDP, it is. So, and if GDP is on the decline, that makes it even larger. So, From that perspective, I think that would only serve to make demand for gold even stronger down the road, and that would be particularly true, if you saw the dollar declining and you did have some kind of problem in the U.S. Why? Well, part of the political backdrop and some of the turbulence going on there is actually linked to losses in their reserve accounts based on officialdom's holding of U.S. Treasury bonds in China. So they're all pointing the finger at hey, we've made no money on these securities we hold that are based on the U.S. It's another little thing you got to watch out for. It's not only and how it links back to the U.S. and how this could be really bullish for gold. Okay, you want to talk about how is China become really bullish for gold? It potentially becomes really bullish for gold if they look to dump Treasury bonds. Okay, we've had periods where they've been small net sellers, and we've had periods where they have, kind of sustained from buying, but we haven't seen any kind of serious liquidation of their holdings. And that's kind of been put aside as something people don't talk about or worry about anymore. Well, I'm telling you, the dynamic in China seems to be a little bit of hostility from some of the political leaders around the immense holding of U.S. bonds, the lack of return that they're getting on these investments. And imagine if you start to get price depreciation. And that, again, would force the Fed back into play, would be a major problem in the U.S., and probably would be quite bullish for gold down the road.
Greg, before we close, I just want to ask you two more things. First, number one, maybe you could touch on anything that we haven't discussed. And secondly, maybe you could close with your targets for gold and silver for the rest of the year, maybe into early next year. I mean, last time we were on, you made an excellent call on silver, which has just been a one-way ticket to the upside the last month or so. So why don't you update us on that?
I mean, we stick with our targets for now. We were looking for 37.50. We're about halfway there. So that, would be a pretty achievable upside target for me in the context of between now and year end. Gold 1805 with an outside chance to break out and and get higher and maybe even test 1900. I think to me 1805. It's easy for me to say today. We're at $40 and we're at 1775, but it has been our target all along. It remains our target. I do suspect there could be some pullback once you do reach these targets. I think Europe still is a major question mark. I think China still is a major question mark, and I think the U.S. bond market is still a major question mark that could easily resurface at some point before year end. And then, whatever turbulence that brings would then be your next step for ECB and Fed, and you go through this whole cycle again. I mean, it's not so much are we going to go straight up to new highs in gold? It's more we're going to get more of the same ups and downs with wilder and wilder swings and more uncertainty and more dependence on the Fed and more debt monetization that is ultimately means higher prices for gold in the long term.
Greg, as we close here, why don't you tell our listeners about the work you do and what you can offer them?
Sure, I'd be glad to. Thank you. We offer global macro market research. The Money Monitor is our primary product. It goes to institutional readers, wealthy individuals, retail investors. Gives pretty specific breakdowns on a portfolio basis. We're bullish gold, we're bearish bonds. We like the German market. We don't like the Japanese market, so on and so forth. And can cover anything and gets very, very in depth to the data, and then tries to meld that with the technicals. So we take a macro data fundamental standpoint, and we take a very micro technical standpoint and try and meet in the middle. We also do the Metal Monitor, which is an audio visual product. It's me talking with charts, interactive to that degree, and is published once a week. And we also offer, we operate a CTA here in the U.S. We offer a macro discretionary program, which is kind of based on the research and pretty much doing everything that we outline in the research. We're very transparent since, it is just me doing all this work. And we also now have our new metals only program, which seeks to take advantage of this exact volatility we've been talking about, seeks to take advantage of the moves in the market. This program is coming into today long gold and copper. We came in today long gold and silver in our discretionary programs. We're taking full advantage of today's moves. And we invite investors to come to our website. It's weldononline.com, W-E-L-D-O-N, weldononline.com, and you can get information on the investment programs or sign up for a free 30-day trial to the research.
Well, Greg, thanks for taking the time to speak with us today. We really appreciate your fantastic insights, and it's always a pleasure to have you on.
It's my pleasure, Jordan. Love to contribute. Thank you.